So Tobias has already introduced a little bit about the topic. When we wanted to launch the center, we didn't want to do it with a topic specific to one of our individual research projects, but something broader, and also could be educational for those of you who maybe don't know that much about African economies at all. So we decided that we would take up this theme about Africa rising and is Africa not rising. For those of you who don't know, the Africa rising narrative, which Tobias talked about, really hinged on the idea that GDP figures of average growth on sub-Saharan Africa averaged 5.6% a year between 2002 and 2008. And at that time, it made it the fastest growing continent or region in the world. Growth dipped, of course, with the global financial crisis in 2008, but then it rebounded almost just as high. So we still had this Africa rising narrative until you get to around 2013. Then we see growth slowing. And by 2016, last year, it's very clear that something has happened. And the IMF says that it is the lowest growth that sub-Saharan Africa had seen in 2 decades. This is when international observers began to say and to question whether we are seeing the end of Africa rising. The IMF forecast average growth for the subcontinent to pick up slightly this year, to average about 2.9%, which if you take into the rate of population growth, this is just about sustaining per capita incomes. So this is a surviving, but no longer really growing. What was driving the growth surge in the 2000s and in the early 2010s? And why did it stop? And what are the implications for African economies going forward? This is what we will address briefly. We'll briefly answer in launching the center. So what I'm going to give you is definitely broad brushstrokes. Feel free to come in with some questions about specific details as we go. Again, for those of you who don't know, it's important to give a little bit of history. The growth turnaround in Africa actually began in the mid-1990s. The recovery from the Third World Debt Crisis in the early 1980s. So we had structural adjustment policies in the 1990s. These were characterized by rapid trade liberalization, deregulation of economies that had been heavily regulated with state intervention, and privatization. And these policies, combined with large foreign exchange capital inflows from the IMF, World Bank, and bilateral donors, led to sustained but modest growth from about 1995 in half of African countries. And again, Africa is a large continent, so whenever we talk about trends, they never apply to every single country. But this sustained modest growth, this growth turnaround, characterized at least half of the countries, those not in armed conflict at the time. But what this period did with structural adjustment and growth, the growth turnaround, it basically reoriented African economies back to their old Ricardian comparative advantage as primary commodity exporters of oil, minerals, metals, and agricultural goods, particularly tropical agricultural goods. So they went back to specializing this. The 1960s and 70s had been characterized by an attempt to diversify economies, and its attempt with import substitution industrialization largely failed, which was indicated by when you had rapid trade liberalization and economies opened up, most of these firms failed. They couldn't move into export, and they couldn't even compete against imported consumer goods. So you had what people talk about deindustrialization. So really a shift back of these economic structures to specializing in primary commodities. This is why, when the commodity supercycle began in the mid-2000s, African economies did very, very well, particularly resource-dependent economies. This boom was driven largely by China's industrialization, and thus when China's growth began to slow down, and it is currently engaged in rebalancing in its own economy, this led to a concomitant fall in the prices of many commodities, and thus falling African growth. And we can see this just quickly for those of you who are not familiar with it in some commodity price charts. This is petroleum, aluminum, or aluminium, the British in the audience, copper and gold. Petroleum's here, you can see the big spike. So this is 1999 to 2016. Petroleum is this one. So they all start from a low base, by the way. So this is the consecutive decline of commodity prices in the 1980s and 1990s. Slowly increasing, but really by 2005 we see this spike in all of them. It's particularly high in gold. The only one that doesn't spike is aluminum. And then we see clear falling with the most obvious drop in oil prices, which are still low. And we see also, this is the blip around the financial crisis, the global financial crisis 2008, but you see it largely recovers and even more for gold. If we look at export prices of agricultural products from 1999 to 2016, largely the same trend, not as dramatic. So this is cocoa in the blue-green, coffee, Arabica coffee in the gray, and cotton and the dashed. This trend was strongest for cotton. Coffee not having so much of a blip. Cocoa doing well, taking off, but it largely recovers. So agricultural goods don't follow the trends as quite as strong. They're not quite as driven by China's industrialization as metals and minerals. And coffee here is rebounding because of a real and perceived shortage of cocoa coming from Ghana and Côte d'Ivoire. But what we can see from the commodity prices is that the growth surge in sub-Saharan Africa, and there's general agreement among economists on this fact, that is driven by these strong commodity prices and the new discoveries in natural resources that they propelled. High oil prices, high gold prices made it more advantageous to seek out natural resources which previously had seemed unprofitable to seek out in Africa. So we see new discoveries in oil, for example in Ghana, oil and gas, Tanzania, Uganda, and massive foreign direct investment in extractive sectors, pouring more investment into gold in particular, copper. But the second major source of this growth surge, which is sometimes not so much talked about, is the ability to access new sources of financing, development financing. African countries had very limited sources. They were aid dependent, and that was about it. But two things happened in the mid-2000s. One, the surge in commodity prices and investments meant that African countries could now engage in what's called resource swaps with China. So Chinese development banks gave massive loans, which were backed with collateral of the natural resources that they would be extracting. This one's often talked about, actually. But the second one is the ability to access international private capital markets. So African countries benefited from debt relief in the mid-2000s through the Heavily Indebted Poor Countries Initiative and the Multilateral Debt Relief Initiative. So all the debt that they had accumulated in the 70s and then through structural adjustment loans in the 80s and 90s, this was largely written off. They are now able to access international finance markets. And they did this. African governments began issuing Eurobonds, and increasingly so after the global financial crisis. As interest rates fell in Western markets, international investors, in the search for yield, increasingly lent to African governments, and the number of Eurobonds issued after 2008 was quite large. This source of new government revenues from taxing commodity exports, from state-owned shares in extractive sectors, from corporate taxes of multinational companies, as well as Eurobond issues and resource swaps, led to high government spending. So another aspect of the growth surge in African countries was driven by government spending, consumption-led. And this was particularly in infrastructure, in construction sectors, and in social services and in public services. If we look at the structure of the economy, we actually see very little change in agricultural productivity. Some countries, but not in most. And the manufacturing sectors tended to stagnate or collapse in many countries. They grew in only a few. And if we look at manufacturing as a percentage of GDP, it's low in almost all African countries. So there's a general agreement that the growth surge actually led to relatively little change of the structure of African economies. And this is, of course, why when the commodity prices go down, they have such a significant effect. It is true that compared across to the rest of the world, that African economies on the whole continue to be less diversified if we compare African countries to other regions. However, if we look within African countries, actually, we begin to see divergence in their trajectories. And that's what I want to talk about in the second half of this short presentation. In a very simple sense, we can think about three trajectories. We can think about resource-rich, commodity-dependent. In this sense, we are talking about an African economy that depends on 1, 2, or 3 primary commodities for a majority of their export earnings, for a large percentage of GDP, and for a large percentage of government revenue. That's what we mean by dependent. Then we can talk about non-resource dependent economies, of which there are actually a lot. They may have resources, doesn't mean they don't, but they're not as dependent on these 3 parameters I just gave. And then we have still a group of countries that we sort of put under political crisis or conflict-ridden, where the absence of political stability makes it hard to generate economic growth. I'm mostly going to talk about, or I'm only going to talk about the first 2. So of course, resource-dependent countries had very high growth rates during the boom, and then they were the hardest hit, especially the oil economies. In these economies, growth plunged in 2016, and it's expected to be modest in 2017. This is just IMF forecasts of real GDP change in 2017. These economies include countries like Angola, Nigeria, Ghana, Zambia, and South Africa. Angola and Nigeria are oil economies, and they have been hit hard by the plummeting oil prices. Ghana is dependent on oil, and dependent on, actually the gold price made the biggest change here. It's dependent on cocoa, gold, and now oil. But it's really the plummeting oil, gold prices that have made the big difference. Zambia dependent on copper, and South Africa is actually heavily dependent on gold. Many of these countries are also the ones that borrowed heavily in international financial markets, issuing lots of Eurobonds. Ghana has issued 4 or 5, actually 5. And in recent years, they have faced credit downgrades from the crediting agencies, which means it's more expensive for them to borrow. And as they can't actually pay back that debt, they are rolling it over by issuing new debt, and that new debt becomes more expensive. They now face more limited borrowing options, and potentially in countries like Ghana, perhaps Zambia, we can talk about, really do face a new debt crisis with no potential. They are saving oil money in a special fund just to pay back Eurobonds, but let's see if it's enough. In contrast, the non-resource dependent countries experienced sustained growth above 6% in 2016. So already we see a divergence. Research dependent countries, growth plummets. Non-resource dependent are still steady, and their growth is projected to continue.